Hi there, welcome to Kneppy Invest, and welcome to another article reaction. The second one I've done. The first one was looking at a Motley Fool article, and I thought, why not spread the love around and have a look at another site I tend to go to quite often. That is Livewire. I tend to read, and when I say read, I'm using that word quite generously, about 30 articles a day. And again, some of those articles I just skim through fairly quickly, maybe take 30 seconds to look at. Some other articles I do spend a little time on. And I thought with Livewire, what I'll do is go back through the last week and have a look at their most popular article that they have released. And this is it. I didn't spend much time on this particular article because I just had a look at the companies and that's about it. But there were quite a few companies that tickled my fancy. Put it that way. Companies that I do like, but even though I do like these companies, some of them I still think are quite overvalued or expensive. So this particular article from Livewire, released on the 21st of March 2025, 9 ASX stocks the pros have been eyeing amid the market pullback. So we have Rudi, we also have Jun Bei Liu, and the other one I don't know much about. The other guy, Romano Sala Tenna from Katana Asset Management. His three companies he selected were actually quite interesting. So let's go back to Rudi and see what companies he thought are maybe good pullback buys. The first one is actually technology. Actually, before we have a look at the companies, I do like Rudi, and he is taking a cautious stance right now, and I'm taking a cautious stance right now. And he's also mentioned here uncertainty around US policy, tariffs, and consumer sentiment, which is my line of thinking. So possibly I like Rudi even more. He has personally increased his cash holdings and defensive allocations. I have not increased my defensive allocations. I'm not a big proponent of doing that personally, but you can do whatever you want. Anyway, his first pick, Technology One, which is not a shock if you know Rudi at all. I would say this is his favorite company on the ASX, although you probably have to ask him, or ask him that question. This is a company I do own, but I have taken some off the table. And the reason I have taken some off the table of this high quality company is because I do think it is still a little bit expensive. P ratio is about 70, between 75 and 80. And historically, the P ratio for this company is around 40 to 50. So there is still potential downside for this company. Now, this is definitely a high quality company, brilliant growth over the last 10 years plus. A nice return on equity, nice return on invested capital. Can't complain about that. And there is still potential for significant growth moving forward for this company. So it's really about valuation for Technology One, even though the share price has pulled back a little bit. His second company is Xero. I do prefer Technology One in terms of quality, but definitely Xero has that potential in, say, 5 to 10 years to be considered a high quality company on the ASX. The only reason I wouldn't go there just yet is because it's only been profitable for a little period of time, maybe 1 or 2 years. And I need to see a little bit more history, but definitely significant growth is potential for this company. They have that potential to grow globally as well. And just like Technology One, there is probably some questions about the valuation of this company. Now, with that growth, if they do experience significant growth, that valuation could be justified. Now, the share price, just like Technology One, has pulled back, according to Rudi, about 15%. Now, is that enough for me to justify adding to my position in this company? This is another company I do own for the longer term, and I'm not there just yet. So what I typically do with my high quality holdings is these are the holdings I want to own for the long term. If I do think they're a little bit expensive, I will take some off the table. But when I see some value, I might add to those positions. So I do like Xero, but again, I still think it's a little bit overvalued at these levels. Goodman Group, this is an interesting one. So this is another company I do own, company I own for the long term. I mean, they did experience some problems during the GFC, but that was almost 20 years ago, to be honest with you. And they did, I think, learn from that. And this company has been getting into the data center area. And that's actually one of the reasons I did buy into Goodman Group, just because of that pivot. Not a big pivot, but definitely that pivot. And the market liked that as well. The share price took off over the last 2 years. In fact, let's have a look at the chart for Goodman Group. It would have been probably late 2023 when the share price took off. Let's have a look. Yeah, late 23. And that's actually when I bought some shares at 2089. It's all about the data center pivot, and the share price did take off. We have seen the share price pull back. Our share price has reached a high of about $39. Now it's $30.69. We have seen a moving average crossover, so that can be a negative thing. But for companies like this, I don't care about technicals. The main thing I'm looking for when it comes to these sort of companies is valuation, and that's about it. I don't care about the chart. I'm just looking at valuation because I do consider these companies high quality, sort of companies you want to own for the long term. Now, just like Technology One and Zero, I'm not so sure there is value in Goodman Group, even with this pullback. Okay, let's move on to Jun Bei Liu. Sorry if I completely mispronounce your name, which I tend to do. I'm a white male who can't pronounce any or non-white male names. From 10Cap, I believe she's a founder of 10Cap. Yeah, I do like Jun, not all the time, but Jun and 10Cap are probably a little bit more bullish than Rudi. And there's a quote here. Right now, we see select opportunities emerging, particularly in companies with strong cash flows and structural tailwinds. That's fair enough. But 10Cap recently mentioned that they have taken the hard landing off the table, which I think is strange and unusual, because I do think the chances of a hard landing is actually now greater than it has been over the last 5 to 6 months. So that's interesting that they have gone down that road. Her first pick is Pro Medicus. High quality company, quickly growing. There's nothing else to say about this company. Another company I do own, but again, valuation. Now, this is another company that I have taken some off the table. And if we do see the share price continue to fall, and it's fallen a fair bit today, by the way. So I'm recording this video on March the 27th. Time is 2:16 p.m. local time in Brisbane. Share price has pulled back 7.44%. So I bought Pro Medicus quite a few years ago. During this uptrend, I was thinking, well, maybe I should take some of the table. And I took some of the table about 3 weeks ago. And I will not buy back in, I will add to my position if I see some value. Now, P ratio for Pro Medicus is probably about, I'd say, still 200. In fact, TradingView, let's see what TradingView says. Price at 242. So this company has to experience significant growth in their profit and cash flow to justify that sort of PE ratio. So when we do see the market having a bit of, I wouldn't say a hissy fit, I think this correction we have seen is justified because of uncertainty. But because of what we are seeing now, companies like Pro Medicus that have a really high PE ratio have way more to fall. And in fact, the share price of Pro Medicus has dropped since its peak 30%, which may not seem a lot, but the share price of this company has significantly increased over the past few years. So a drop in 30% is not all that much. So I'm not sure when I'd add to my position. A way to do that is just have a look at the weekly chart and have a look at the 200-week moving average. And this is a technique suggested by Charlie Munger. Buy high-quality companies when the share price reaches or nears the 200-week moving average. So that's that red line. And at this point in time, the 200-week moving average for Pro Medicus is about $112. So that's another 50% down from where it is right now. Could it get there? Definitely, it could get there. It could get there. Because it wasn't that long ago, the share price was at that level, that moving average. Yeah, back in May 2023. Yeah, so it could get there. Even the share price has rallied a fair bit. So I do like Pro Medicus, but again, valuation. And I'll be honest with you, I wouldn't mind the shares of these companies to keep on dropping. So I can add back what I sold out. She also included Goodman Group. So 2 of these experts chose Goodman Group, and I can definitely understand that. So we can move on to the next one. Light and Wonder. Okay, so this is another one I own. So you see a bit of a theme here. I own most of these companies, so I shouldn't be disagreeing with any of these experts. And I'm not really disagreeing. It's only about valuation. Light and Wonder, this is an interesting one because all those other companies, we have seen a share price pullback. We haven't seen a massive pullback in Light and Wonder's share price at all. This is, I could definitely see why people would not buy Light and Wonder because of ESG issues. I'm not a big fan of casinos, not a big fan of slot machines. In fact, I hate slot machines. But I don't have a filter like that. I just invest in companies that are growing, have the potential to grow, and I don't think ever we'll see slot machines, poker machines being banned. And that would hurt this sort of company. Back in September last year, we saw share price fell a fair bit because one of the machines or something was developed by Aristocrat. Share price fell a fair bit on that day, and we have seen the share price recover, but we haven't really seen the share price drop. And some might even say that Light and Wonder could be defensive because gambling, you might see an increase in gambling during tough times. So we haven't really seen a pullback with Light and Wonder. So I'm a little bit surprised this was chosen because, yeah, there hasn't been a pullback. But would I consider Light and Wonder to be a high-quality company? It has the makings. And the reason I say that is because a lot of the talent that was in Aristocrat have moved to Light and Wonder. So definitely a potential a high-quality company in the future. I don't think I'm there just yet in calling that this company high quality, but I do think it has potential. Okay, and let's move on to Romano Sala Tenna, Katana Asset Management. Yeah, I don't know this gentleman all that much. Sees a pullback as a necessary cooling off period with a long-term bull market. I would say we're at the end of a long-term bull market. I think unless we get more clarification when it comes to tariffs, I'm not sure I can say this is just a little bit of a correction in the long-term bull market. The reason I say that is if you have a look at, say, the XJO daily chart, we have seen, the market turn. And I think that there could be more downside. So I'm not as confident that this is just a little bit of a pullback in a long-term bull market. I think there is potential more downside. So I'm not sure if I agree with Romano right there. Now, I do also have to note that these sort of experts need to be more bullish than I probably want to be. Anyway, he remains overweight in gold, seeing it as the only sector still trending on the ASX. And that's absolutely right. If you're heavily invested in gold right now, you're doing fantastically well. Now onto his picks. This is where it gets interesting because this was where the theme sort of falls apart. So I thought this was all about companies whose share prices have pulled back, who might be great buys right now. The first one is IPH Limited. Well, the share price hasn't pulled back because the share price of IPH Limited has been a long-term downtrend and it just keeps on dropping. I have recently had a look at this as a possible value play. And let's have a look at the chart for this one. I still remember I researched this company maybe 2 or 3 years ago, and I thought it was ridiculously overvalued. And that's probably when the share price would have been, maybe $10. Share price has halved since then, but this is a long-term downtrend. The company did release something negative, must have been the 12th of March. Share price has bounced off that. That could be the low, nice little bounce, but the share price has hit the 25-day moving average, and we might see further downside. But the interesting thing about IPH is just the valuation. So I think this is more of a value play. I wouldn't consider this company high quality, and that is why I did research not that long ago. So I did initial research about 3 years ago. I thought it was too overvalued, and then I did a little bit more research. And my main concern about IPH was the lack of earnings per share growth. So really nice revenue growth, but earnings per share growth over the last 5 years has only been 1.7%. So even though revenue has been growing, I think what they've been doing is acquiring. If they haven't been acquiring, that would be concerning. That would be hinting that margins have been decreasing if you see revenue growing at a much greater rate than earnings per share. But the P ratio for this company is below 15. And I think that could be good value. And the reason I say that is if you have a look at the historical P ratio of this company, it's at historically low levels, which is intriguing to me. I'm really going back to my value investing ways, which I still think it's instilled in me. Here it is. There it is. So the last time P ratio of IPH got down to these levels was back in 2018. So this was March 2018. And if you have a look at the chart, have a look at the weekly chart, and go back to March 2018, you'll notice that's when the share price dropped to its low of around about $3.50. And the share price is moving to those levels right now. So I do think there is possible value in IPH. So yeah, I've been looking at this company a little bit more and more, but it hasn't pulled back because of the market. It's just been pulling back because of the company. Dicker Data was another one, interesting. I'm probably not there just yet with Dicker Data. Remember, quite a few months ago. We can be able to see that when we look at the daily chart, and it must have been May, maybe May or August. No, it would have been August. I reckon it was May. Dicker, Mr. Dicker, the founder, had to sell a lot of shares because of divorce. And I thought, oh, typically when that sort of thing happens, the market panics, and that's a good buying opportunity. And I actually did buy some shares, but the share price didn't bounce. Well, it bounced quite a bit after that, but you can see the share price has dropped significantly since then. So this is sort of like IPH. Share price keeps on dropping, and unless I see really good value, I want to stay out of these sort of setups. So Dicker data, share price is in a downtrend, and the P ratio is at 19.17 according to TradingView. So let's just have a look at Dicker Data's P ratio. So I think there is possible value for IPH. Can we say the same thing for Dicker Data? Let's just have a quick look at the P ratio. Now, this is a really rough look at valuation. And the P ratio is about 19 to 20. And it has been significantly lower than this, but before COVID-19. In fact, before then, the P ratio for this company hovered between about 10 and 20. Now it's at 19. So you can say over the last 5 years, yeah, the P ratio looks attractive, but before that, maybe not. Anyway, by the way, I should also mention, we have seen a bit of a slowdown in growth over the last few years. In fact, revenue has been growing at negative 2.8%. Over the last 5 years, 5.3%. So that is a bit of concern. We have seen a slowdown in revenue, and earnings per share over the last 3 years has only been growing 0.8%. And that is why the share price has been pulling back, is because of lack of growth. Growth, for me, is quite important. Nice return on equity, nice return on invested capital, and if you do like a yield, 5.1% dividend yield. Okay, so yeah, I don't know. If I had to choose between IPH and Dicker Data, probably just IPH just because of valuation. But if Dicker Data share price keeps on falling, that company will become more attractive. Not only because of valuation, because also dividend yield. The last one is another company I own. So this is a gold company I've owned for quite a while, West African Resources. The main reason I bought West African Resources is because they went into production, and based off their cash flow and based off their valuation, I just thought it was a great opportunity. I know this company. They have operations in Burkina Faso, which is a landlocked country in Western Africa, hence the name West African Resources. So there's always going to be this sovereign risk. And during the time I've owned West African Resources, there's been a coup d'etat in Burkina Faso, and that has not affected this company at all. But the most important thing is this company will be starting a new mine. It's going to double their production, and I don't think the market still understands that, maybe. And I'm pretty sure that Romano, or his name is, mentions that. Mid-tier gold producer in West African. The company's on track to produce 4 million ounces over the next decade, with the annual production peaking at 473,000 ounces in 2029. Doesn't really mention that they will be starting that new mine, but that's happening within the next year. And there's also potential. Oh, actually, they mentioned here, gold stock with strong free cash flow, absolute truth, and a management team bringing its new Kiaka mine online soon, doubling production. And also a possibility they actually might start a new mine. Don't know. So I do like this company, just again based on valuation. I bought this company quite a few years ago and already up 100% on it, and it's in the gold sector. Most gold companies are doing well, except for a few, Bellevue Gold. Anyway, so nice. Interesting group of companies. Romano, not sure he got the note, what he was supposed to do, because if you have a look at West African, share price has not pulled back. Share price is in a beautiful uptrend. Anyway, so I don't think he didn't understand the point of this particular article. Look at that beautiful uptrend for West African Resources. I think the other ones did, because, Technology One, Zero, Guma Group, they've all pulled back, but whether that pullback is enough for me to be interested in adding to my positions, I'm not sure I'm there just yet. Okay, that's all I have for this video, looking at these 8 companies that the pros are keen on with this pool. But if you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.